But that 15.5% is market driven, right? And this is, I think, a point of confusion that I want to address now. That we are not deciding that. It sounds like APR limit perhaps could be worded better, because that sounds like we are deciding that that's what it is. But that limit is actually 100% market driven. We don't impact that at all. We set where it initially started. That was just because it needs a place to start to continue. But then once it's off and running, that APR is completely market driven. So if we had a huge influx of capital, the APR would go up. And when we're not seeing much activity, then the APR comes down. And that's just how it works, right? And I've spoken about this before, and that I never liked. So I was criticized in V2 for not capping the APR, because the APR in the first epoch was so high that it ended up creating situations where the APR was trying to keep up with something that didn't have the cash flow for, and we just depleted everything very quickly. So people wanted a cap. And during V2, I addressed that and said that I didn't want to set an arbitrary cap, because who am I to decide that, what that should be? I wanted something market driven, and we figured that out. Like the V2 or V3, sorry, like the current mechanism has a market driven APR limit. So yeah, it's 15%, which I think many people were shocked by. Perhaps they haven't been paying attention to what we've been saying, or read the white paper, or hung out in the Discord, or any of that kind of thing, and that's fine. But they went into this expecting something that it just wasn't anymore. We launched V1 during a frothy bull market, and we saw a huge amount of inflow of capital, and high APRs do that. And if I cranked the APR on this version to 10,000% and launched it, they would have done the same thing. But the problem is with that is ultimately the money has to come from somewhere. That was always true. That was true in V1, V2. And the reason we could pay back V2 was because there was some throttling of the APR, just not as intelligently as it is now. And that allowed us to kind of sustain a little better than we could have done before. But really, when it comes down to it, when money comes into the protocol, let's say the price goes up and the protocol mints a bunch of malt to sell it. In those cases, the money has to be split between collateral and LP yield. Those are the two places that the money goes. So we could put 100% of it into collateral, in which case we pretty much guarantee that we're at 100% collateral the entire time. In fact, we'll be above 100%, because every time we mint, we're minting above $1. And that means that we would just forever be above, because every time we mint, we're minting more, or less, than we're receiving in DAI, because we're selling above $1. So in those cases, we're fully collateralized. So we could literally just turn on, we could turn this on right now if we wanted to, and say that all cash flow goes to the collateral. It all goes to the swing trader, for example, or splits between the swing trader and the liquidity extension and the overflow, which are the kind of three internal collateral sources. But then if we had, I guess, that was a slight lie, it wouldn't go into the overflow because we're turning off yield. So if we just put all of it into swing trader and liquidity extension, we'd be above 100%. We would just sustain a stable coin forever, basically. And the only way the supply of the stablecoin grows is if people buy it. So then it has this kind of naturally market-driven thing that just collateralizes as it goes. In many cases, that's functionally identical to a traditional stablecoin, with this additional juice, which is the fact that the protocol is selling it for slightly above $1, rather than just buying it off a trader for $1 exactly. And that additional delta there would be additional collateral that would enter the system, and that would be a fully collateralized coin. So that's one thing that we could do, and in many ways that would be a better model than traditional stablecoins, because it has a way to increase collateral over time. So that's great. Malt can operate like that if we wanted to, and things would just work. But then on the flip side, we could also redirect all of the profit that the cash flow through the protocol, we could direct it all to LPs. And let's say we don't cap the APR, we just give it straight to them, which is in many ways how V1 worked. And we all know how that goes, right? The APRs are crazy. But it's going to die eventually because the money, as I say, has to come from somewhere. And the money's coming from the cash flow, and none of it's going to collateral. It's all going to LPs. So the LPs who get in early get rich, but you have to get out quickly because you know the protocol is going to fail eventually. It might be days, weeks, months, who knows, but it's going to fail eventually because it has no backing, and the reflexivity of the market, especially at the depths of a bear market, they're just not going to be sustainable over the long run. The only time that under collateralization is going to work for a project like Malt or any other that's trying to do things like this will be once you've already got the belief in the people using it, much like the kind of fiat backing of a regular government issued currency. When you have the force of ultimately the military backing the value of that coin, then people trust that even though there's no intrinsic backing like gold, there is a societal backing of some form, but it's more abstract and socially constructed as opposed to being a physical asset. And I think that's really the goal of an algorithmic coin. Ultimately, the dream of your kind of OG algo staples like a DSD, ESD kind of vibe, and even to some degree UST, although that's a bit of a nebulous one. But the kind of core dream of an algo stable is to be able to recreate the cultural backing that kind of government issued coins have. And that was Malt's original goal. And I way overestimated the power of that as it pertains to a brand new project. I was launching and expecting that people would just kind of like ape hard, and then over time, as the thing worked, confidence would grow. Of course, that was, in retrospect, somewhat naive, but here we are. V2, we built it better, right? It worked much better. Because we made the distinction between there's two places that the funds can go, and we need a smarter way of distributing between collateral and LP yield. That system was better in V2 for sure. I think I don't want to say perfected it this time, because perfect is a difficult word to meet the expectations of, but it is absolutely undeniable at this point that the thing's working. Malt is working exactly as expected. Nothing has happened so far that is panicking or unacceptable or unexpected or anything. It is working exactly how we intended it to, and it will continue to do so. I see no reason why it won't. So the only thing to worry about, and this kind of leads into the larger conversation that we're going to have today about the future. What happens in the future, and how do we deal with the future? And I think the big thing to address at this point is kind of the different sources of yield or the different sources of collateral and how the runway ties into all of this. So I'll start from I'll assume nothing. So for many of you who already understand this, you'll just have to sit through my explanations, but then that'll leave everybody in the same position where they all have the same baseline of understanding. So within the protocol, we have multiple sources of collateral. And if you go to the auction page on the Malt UI, you will see, if an auction isn't running, you'll see a card that says what the total Malt supply is, the collateral percentage, and then how much capital is in the swing trader, reward overflow, and liquidity extension. And those three, the swing trader, reward overflow, liquidity extension, they are the core sources of yield, core sources of collateral within the protocol. And two of them are fixed. They're owned by the protocol in their entirety. And that's the swing trader and the liquidity extension. So that's just protocol collateral, right? We don't need to use the word implied there. That is legitimately just collateral. And if you look at that card on the UI, you will see that almost all of the collateral the protocol has is owned by the protocol. It's about 97.5% if you do the math. So we're at 99.3 total, but 97.5 is owned by the protocol. Functionally, what that means is that Malt can pretty much guarantee a floor of 97 cents indefinitely, because it has enough collateral internally to the protocol to buy it all back. The only kind of implied slash volatile part of the collateral is the reward overflow, because that's simultaneously being used for two things. It's being used as a backstop on the token price, so as a form of collateral to buy back, but it's also used to pay the runway of the APR. And that's why we call it implied, right? Because it's not guaranteed collateral. If like the entire world goes into a coma and we come back in a month, the reward overflow will be depleted, right? It will just, every epoch, it will start dripping money out to continue to fund the APR. And this is the whole point of the reward throttling system, that instead of throwing out 10,000 APR, 10,000% APR immediately, and then running out like we did in a V2, we instead can pay a much lower APR, but sustain it even when there's no activity in the protocol. And that's what we've basically seen over the last 24 hours, basically. 22 hours, I guess. The first 2 hours, there was a lot of buy activity, and the reward overflow was growing because we had enough cash flow to pay that APR, so it grew. And then as the activity has slowed down, we're now having to dip into the overflow to reach that runway, which means the runway is depleting over time. So right now we have 25 days, and that's at the current 15%, or 26 days, sorry, at the current 15%, and that APR is going to drop when there's no activity, which is what we're seeing, right? And that's the elephant in the room. What happens if that goes to zero? And I think it's worth addressing that and kind of speaking to that and what our plans are and how we think about this and how you should think about it, or perhaps how you should position yourself around it, perhaps is a better way to think about it. So, as I say, if nothing happens for the next 26 days, we all just like go on holiday together and come back in 26 days, then the APR will have dropped some amount. How much, I don't know, but it probably quite a lot because there's been no activity. And then the runway will be zero because we've just used all the overflow to pay out the APR. That's what would happen there, which means the collateral ratio drops because, as I say, we only have 97.5% in protocol-owned collateral. So we would basically drop, presumably, because people are not going to want to stay in the protocol if there's 0% APR. So many people will leave, and that will cause the price to drop, and the swing trader will purchase depending on exactly how far the price drops and how much slippage the people are willing to accept when they exit, and whatever slippage they do accept is going to be arbed away by the swing trader, and that's going to increase collateral as that happens. So in terms of the price of Malt, I think if we go to a 0%, or if we go to zero runway, we are going to see the protocol survive, right? And people might leave, the TVL might drop, but the coin will stay at $1. Of that, I'm very confident. Maybe not $1. $1 might be a bit extreme. I think it will personally, but I wouldn't bet my life on it. But 97% for sure, because 97 cents for sure, because that's how much collateral we actually have internally to the protocol. So I think that's really what would happen. If that happens, the coin would survive, it would be fine, it would keep functioning. And that's something that can't really be overestimated, because if you see what's happened to the launch this time, we launched, we had some activity, and then a bunch of people decided to leave because they didn't like the APR, which is fair enough, and then the TVL is kind of like just chilling for the most part. Some people leave, some people enter, but it's not this explosive thing that we saw in V2. And we've seen some large exits, right? Relatively speaking. Of course, there was some wallets that had larger than the TVL in other versions, but relative to the TVL, we've seen some pretty large exits. Yet, here we are. We're still at 99 cents price. We're still at 99.3% collateral. we've still got 26 days of runway. But what has happened so far in this version would 100% have killed V1 for sure. Like, without a doubt. If we had a launch like this on V1, it would be dead. Within hours, probably. V2 may have survived a bit longer, but probably not that much longer overall. Where I genuinely believe that this version will just continue to work forever, for the most part, until everyone takes out their money. At that point, it will obviously go to zero because there's no liquidity, but I mean, at the end of the day, I'm probably going to keep my money in there just to allow myself to keep building. And like, so part of me thinks that if I was the only one in the pool, it would be allow me to work more efficiently, because I would only have to answer to myself. But of course, that's not how you build real things, and that's not what we're going to do. But that's the only case that I'm worried about in case, like, of Malt going to zero, is we all leave. We all just take our money out and go. That would send it to zero. But other than that, if there's still money in the protocol, it will still survive. It will continue to survive, excluding any code risk, of course. But I think that's a huge win for us. Like, that is a unbelievably big success for us to say that we went through a first version that was, I mean, catastrophic. The second version that was fine, but had some issues that needed to be ironed out, and some inefficiencies, etc., etc. Now we have a protocol that is just working. By any stretch, that is a massive success. Perhaps the APR isn't as nice as people want, or the TVL isn't growing as fast as people would like, or whatever. There's always things that we can dream up that means that we aren't succeeding. And many people might try to make that argument, but I think objectively, looking at what's happening, this is a massive success. This is an order of magnitude minimum better than the previous two versions combined, probably. So we're really maturing, and that's the metric to judge. It's, are we continuing to improve? And I think the answer to that is yes. And will we continue to improve? Of course. We have many ideas, and seems like a good segue into what those ideas are. So I've spoken some about, like, our kind of roadmap. Our long-term plan is to have our own AMM, and that's always been the case, continues to be the case, but building an AMM is a very difficult task if we're going to do it in the way that we'd kind of like, which is to really make the stablecoin a first-class citizen within the AMM and allow the stablecoin itself to do interesting things internally to the AMM in a privileged way. Basically our current ARB infrastructure, but baked into the AMM. That's our ultimate goal, and then we can derive loads of edge there because we can have zero fees for our own protocol, for example, because that zero fee is ultimately getting fed back into the protocol for LP yield. So while the fee is there in a typical AMM to provide the return for the LPs, right? That's the incentive for the LPs to provide liquidity in the first place, is that fee. So they want that because they need the incentive. They can't just say, just put some liquidity in here and, like, that's fine, you're chilling. That's not how things work. So that's not something that we can do. That's not something that those AMMs can do. They can't just turn off the fees, because then why would anybody provide liquidity? But for us, we can, because there's another source of yield. I think there's still fees for traders on that, so that's an additional source of yield for our LPs, like a traditional AMM. But then for the protocol's internal stuff, like the swing trader, we can have zero fee because the ARB itself is creating yield for the LPs. And that ARB, because we get 0% fee on that, we have immediately edge. Like, let's say it's a 30 basis points fee for a typical trader. We have a 30 basis points edge against every other arbor on-chain. And that's a pretty substantial edge to have when faced off with things. So that's our long-term plan, is to have that. But in the short term, there's two things that we need to figure out, and they're very related, of course. So one is cross-pool ARB. The easiest way to do that will be to have another DAI pool on a different DEX, let's say. And then we can just ARB the Malt DAI pools against each other. We can say this one's trading under, so we can just do a risk-free arb across that. And that's like other people are going to be able to capture that arb to some degree. We're working on some ideas internally that will help with that. But that's not something that we have right now, and it's an active development. But when we have that, we'll be able to arb across the pools, which is an additional source of yield, and also keeps all the pools stable. And I think we can get there pretty quickly if like that's something that we prioritize. But additional to that, the real holy grail will be non-stable pools. And that would be like ETH, for example. If we can have a pool against ETH, you earn yield in ETH. Earning 15% yield paid in ETH sounds pretty attractive to me. Like I would 100% want to accrue, like stack more ETH by providing liquidity to a thing. And 15% is a lot for ETH. And then additional to that, we could do a pool against a liquid staking derivative, where you're already making, say, 5%. And then you can make 15% in the token that's already accruing 5% on an asset that you're most likely bullish on, and think it's going to go up over time. Like that's an unbelievable position to be in. And that's really like DeFi is heading that way. And if we want to be a decentralized stablecoin, having some facility to be backed by ETH is a huge deal. So there's many things in there that we can do. And if we can generate ARB on non-stable assets, this is the really big deal, which is the difference between stablecoin pools and non-stablecoin pools. And I think the activity of the last 24 hours is really perhaps making us reconsider our position on the priority of non-stable assets. It's always been in the roadmap. It's always been something that we've wanted to do. And our plan has always been to roll out ARB across stable assets first. But then with the way that this launches went and the kind of lack of demand that we're seeing, puts us in a situation where we have one of two options. One is we just put on our biz dev hat and rush out and start to build network of projects that want to integrate with us and like offer them something and then figure all that stuff out, and then we can grow the utility, give people reasons to use Malt. We have like open lending pools and all sorts of things, and we can do all of that and generate that utility. But at the end of the day, we're still asking people to take a risk. We're saying the yield generally is going to come from people buying and selling Malt, and that's where the utility helps, of course. But ultimately, you need to buy this Malt and stake it, and that is what generates the yield. It's that activity, and that is how Malt will work ultimately. But the problem that we face right now, I guess, is that there's a lot of people who are on the sidelines, waiting to see how Malt works. And they haven't necessarily just ruled us out, even just from conversations that I've had with people. There's many people who are on the sidelines who played a previous version, but they're waiting to see how this one goes. And that's prudent. But we need to adapt to that. And that's what we're thinking about now, is how do we adapt to that? And I think one of the big things that we can do is reprioritize non-stable assets, because then the natural price fluctuation of those assets, like as ETH fluctuates up and down, there is naturally ARB opportunities against the Malt ETH pool. And if we can figure out how to capture some of that, then there's a source of yield that comes from the energy contained within ETH and the fluctuating price of ETH. Like the volatility of ETH is where the energy is contained, and we can just capture some of that on the Malt pools and provide a source of yield in ETH to our LPs without needing additional incremental users to take risks. Because that is, the stable assets are obviously an easy test bed to work on because the assets are stable, right? DAI is worth a DAI, right? It's worth $1. And we can iterate easily because that's one variable that's controlled. It's not something that we have to predict volatility on. Obviously, we want to bake that in and make sure that we can survive those situations, as we've seen, DAI can depeg, but it's not a baked-in feature of DAI. It's an edge case that we have to handle. But ETH, we have to handle the price fluctuation as a first-class citizen. It is literally what that does. So if we just roll out the current stable asset infrastructure on a non-stable pool, I think things will go very badly, because we're going to be triggering auctions for people to buy ETH at a price that's higher than the price of ETH is right now, because it's not just always fixed at a dollar value. So we, like, as that fluctuates, it changes the dynamic of auctions a lot. And it also changes the dynamic of buying back when the peg changes, because the peg might have changed because the price of ETH changed, and we might be buying a load of ETH back at a higher value than it's worth. So we have to really consider how that, it basically, to kind of reference the white paper, the collateral change inequality has no term in it that takes into consideration the volatility of the asset that you're using for your collateral. So when the asset is DAI and it's 1, that hypothetical term in the equations just like effectively disappears because it's 1. So the rest of the equation just stays as is, and the 1 just is, right? But for ETH, it's not 1. It's different every block. So there has to be an additional term there that we're going to have to figure out, and how to deal with that. And in practice, I mean, that probably means some form of per pool over collateralization, et cetera, et cetera. But as I say, these are not things that we have answers to yet. We have a lot of ideas. I'm not going to speak to them just yet because we need to figure them out before we commit to them publicly, but that's what we're working on. That's our new priority, to figure that out, because that's the fastest path from where we are right now to a point in the future where we can pay a yield to people without needing an incremental buyer all the time to generate that yield. The incremental buyer will generate more yield, but we can't rely on the incremental buyer as the only source of yield for Malt. There has to be more. There has to be utility, which creates an incremental buyer just by the fact that they need Malt to do the thing that they want to do. So that's like helpful for the ecosystem, but also there has to be ways of generating yield that don't require that, and that's where we can capture some of this volatility on non-stable assets. So that's where we're at. Those are the problems that we're working on right now. That was supposed to be a problem that we're going to work on in a few months, probably, once we'd figured out multiple stable ARB situations. And we may still do the stable ARBs first, just as a test run to get the non-stables, but the prioritization structure is very different now, because we have to adapt and be dynamic to what is happening around us and what the market is doing and how the market is responding, and figure out in real time where things can change, like what is actually working, what's not working, where are the places we can improve, are there ways that people are extracting value from the protocol, etc., etc., etc. These are all the things that we have to think about actively and change our strategies as and when we see these things changing. And that's one of the big things right now, is that we're seeing that the activity is not there, so we need to find other ways of generating yield, and the fastest way to get there is to carry arbitrage. So that's where we're at on that. And another point that's perhaps not as relevant for this discussion, but is worth talking about for the people that are listening, because perhaps you're the people that are still invested in Malt, and that's around what our plans are for governance over the long term. And we have no like set in stone things right now. So again, I'm not going to speak to too many details, but we do have a lot of plans for governance. And as I've said in the past, I am not the biggest fan of just dropping a token, because that's generally just like fake. It's just generating a bunch of paper cash flow, but no real cash flow. And that's where you can get the 10,000% APRs if you're just going to mint new tokens and send it to zero. And it is something that we could do. Like if we so chose, we could create a token, throw the token under the bus, and use that to effectively bootstrap large TVL, liquidity runway, etc., etc. on our current coin. We could do that if we wanted to. But I think what we're much more likely to do is not do that, but have a token of some form that is accrued over time to LPs, but based on like their time in the protocol and a whole bunch of other things that we're not going to dig too deeply into, but effectively tying governance rights to skin in the game is the real high level goal. But one of the things that additionally falls out of that is naturally that ends up rewarding the people who've been in the longest. So whatever that plan is, it will be based on skin in the game, and there is no more skin in the game than having been involved in the protocol for a long time. So in some sense, you could think of it like it's airdrop mining or airdrop farming, but it's not, because it's not going to be an airdrop in the traditional sense, but it's probably going to be something value accreting and probably have some form of value capture there as well within the protocol. But again, there's lots to figure out there, and there's a lot that'll change over time, so we can't know exactly what opportunities are going to come up for us and know exactly how that's going to work. But ultimately, that is something that we know we're going to need to do. We're going to have some form of governance. Having a form of governance that's fair and equitable, that rewards skin in the game, is a very high priority. And so, and also just like, it comes down to like wanting to reward the people that believe in what we're doing, because I can't really ever overestimate just how appreciative and grateful I am for everyone that's still putting their money up. Like, at the end of the day, people could say we failed twice, and yet there's still people here throwing 400k at this idea just to see it happen. And that's like, I have no words to really explain just how amazing that is in a market, not just crypto, but just globally, where the capital is drying up across the board everywhere. It's harder to raise unless you're a flashy AI startup, but I don't think I'm raising money on Malt anytime soon. So capital's dried up. Yeah, here we are on a third attempt, and we've still got hundreds of thousands of dollars being thrown in. That's what I'm focusing on, because that's incredible, and I really want to do whatever I can, whatever is within my power, legally speaking, but also just functionally, technically, whatever, to do whatever I can to make sure that I at least in some way make that worthwhile for you, for everyone, and for myself too, and for the team and everyone who stood by me. I'm on a mission to make it all worth it for them, and that includes everyone who invested, everyone on the whitelist, everyone who's bought in since, everyone who's remaining to be in. All of that stuff is I'm eternally grateful for, and to whatever scope I have available to me over the next weeks, months, years, I will do everything I can to make sure that everyone who supports me does well. What that ultimately means, like how that manifests, is yet to be decided. But I hope that my honesty over time lets you know that that's not an empty statement. That's how it is for me. That's genuinely how I see the world. I have a strong sense of right and wrong. I believe that people who help me deserve reciprocation, and things need to be done fairly, and I think that's how I've tried to do it with Malt. There's never been VCs, there's never been insiders who get like huge allocations other than like myself and like the core team. But there's nobody can buy me or Malt, or anyone on the team, in fact. And that's a core ethos for us. We're building a thing and we cannot be bought. Like, are there ways that we could pump this more? Quicker, faster? Yeah, absolutely. If I wanted to sacrifice some of my own personal ethos, then I could absolutely just launch a standard ERC20 governance token, start paying 100% APR in this token, an additional yield to suck up a bunch of liquidity, and We could pump the TVL massive. We could grow the implied collateral. We could do all of that. But that's just not how I want to do it. It's not. That's Moloch in my mind. If you're familiar with the term or the idea of Moloch, it's a game theoretic idea of a situation where one individual can sacrifice a shared belief or ideal, and in doing so gain an edge that then forces the game theory into a situation where everyone else has to sacrifice that belief or idea. Like a common kind of illustrative example would be if you're in a theater and somebody in the front row stands up. There's kind of an unspoken thing that you sit down so that everybody can see. But if you stand up, you've just created a situation where the person behind you cannot see. So the only thing that they can do is to stand up as well. And that just creates a cascade where now you have an entire room of people all standing, and each of them's view is identical, albeit a little higher than it would have been had they all been sitting down, because they're all just standing up now. So the tall person in front of you is still a tall person in front of you. So what's happened there is one person sacrificed a shared ideal or belief, and we've ended up in a situation where the only thing that's changed is we've lost that belief in our group of people, right? We've sacrificed that belief for zero benefit. That's all that's happened. Everyone's in exactly the same position. We just lost this shared belief that we should all sit down to be courteous to our friends. And that idea of Moloch plays out everywhere and all the time. And I could speak for days about it, to be quite honest. And I think my view on regulation, which is a big kind of deviation away from this general conversation, but I think it's worthwhile deviation. In my mind, regulation, the only purpose of regulation is to forcibly stop Moloch. Everything else should just be free market. Everything else should just be let innovation drive whatever's happening. The only place that regulation should exist is to prevent Moloch, because Moloch is a real thing. It happens everywhere, and free market is full of Moloch. Like any free market maximalists fundamentally don't understand Moloch, because Moloch it's everywhere in all society, in all capitalist systems. It's everywhere. So we have to set up infrastructure, which we call regulation, to disallow Moloch, or at least mitigate the effects, the negative externalities of Moloch. In many ways, you can tie this back to crypto with flashbots. Flashbots, in many ways, is a way of relieving the Moloch that exists on chain. When you have these like MEV opportunities, there's a massive opportunity for MEV searchers to just spam the chain with a bunch of transactions, because there's no atomicity to the transactions. So we might have a shared belief that the blockchain shouldn't contain a bunch of useless data. It shouldn't contain a ton of failed transactions or kind of just value extracting transactions. Yet all MEV searchers will throw that under the bus immediately if there's an opportunity to extract profit. And that profit incentive creates a situation where the incentive overweighs the shared belief. And somebody will always take that, because there will be somebody who does not care about the cleanliness of the chain. So they'll just take that opportunity. And then all the searchers that have some kind of like idealist view on the chain, and they don't want to do this, they're just going to end up being left out in the cold. And the people who sacrifice that edge make a ton of money. So the only way to remain competitive is for you to sacrifice that edge or that belief as well, and you start spamming transactions on chain. And therein lies Moloch. And what Flashbots did was, well, let's figure out a way to mitigate the negative externalities of that incentive structure. Let's give the ability to have atomic transactions on chain, so that if it fails, you don't pay for it. It just gets discarded. It doesn't bloat the chain, and it also gives the searchers the opportunity to accurately, like surgically almost, extract value by saying, this is the exact combination of 5 transactions that I need to execute in this order, or don't do it at all. And in doing so, I can capture my MEV, and I can also live happy in the mind that the externalities that exist are no longer there. So there's a use case in crypto where we've effectively introduced a mechanism that's reduced Moloch. So tie that back to the original. I think a lot of governance in crypto creates very Moloch incentives. People, so like if we kind of look at like how Malt works right now. So we have 400k of TVL and some runway, and things are kind of going, right? But by crypto standards, it's not very big. It's 400k. It's pretty under the radar, generally speaking, when you have these like multi-billion-dollar fully diluted value startups within crypto, teams raising $50 million seed rounds and things like that. But the problem with all of that is it creates this really Moloch thing, because you can do it, right? You can just drop a governance token and create huge amounts of value for yourself and your holders, at least initially, until the ones who hold on to it are the ones that really suffer. But the profit extracting maxers that are just arriving in your coin, they don't care about it, and they just like farm it and dump it and move on, they get all the money because they're playing the game theory perfectly. And the people who truly believe in the idea are getting screwed because they're holding on, and they're the exit liquidity for the people who are just EV maxing. So I think that those kind of incentive structures are very negative for the space, and I do think that they create Moloch, because as a founder, struggling or not struggling are two choices. And I say choices, but if you were given the option of, do you want to do this and struggle, or do you want to do this and not struggle? I think many will pick the not struggle part. And one easy way to not struggle, at least over the short term, is just raise a boatload of money in some way. And then you have the runway, the confidence, and all of that kind of stuff to deal with it. But you have to really think about, what are you throwing away when you raise that money? What are you giving up? What edges are you giving up? What decisions are you giving up? What opportunities are you giving up? And then what are you getting in exchange for that? And for many, many, many companies, what you get in exchange is massively worth it. And they should take the money and run. And they should take like the VC money or wherever they raise it, angels, friends and family, and really run with that and have the confidence that they have that 18 months of runway or whatever they're looking for. And they can just put their heads down and build and hire a team and grow their influence by having more team. I would love to have a bigger team on Malt, but we don't have enough money fundamentally to do that, because we're trying to bootstrap it. And the reason that I was always trying to bootstrap it is because this was never a money making thing for me. If I wanted to make money, I raised 10 million and pocket it, right? Or I could have just rugged V1 and walked away with 13 million, right? If I was in it for the money. But I'm not. That's not my incentive. That's not what motivates me. Like, I make money elsewhere. And I'm doing it because the idea is cool and I want to work on it. It's interesting. It's stimulating. But it does mean that we don't have much money to hire a big team. So I'd love to have a crack team of developers and an incredible business development team and some designers and some UX people and some community people and blah, 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 right? Whole 9 yards. That'd be amazing. But we're not there. So I could just raise a bunch of money or launch a governance token, have a bunch of money available to hire the team. But the thing that I'm throwing away there is fundamental to how I think about Malt and how I want Malt to exist. I don't want Malt to be owned by anyone, including me, as at like the protocol level, right? The tokens, fine, but I don't want somebody to be able to just like have a hammer fist and make a decision that is detrimental for the protocol's longevity, purely to make some money in the short term. And that's gonna piss some people off. Like, already has. There's many people who want to see APRs higher and more runway and blah, 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 blah. But that's just not where we can be right now, given everything that we have available to us. We don't have like a marketing budget to really spend to gain huge traction. We also don't even know if the protocol is going to work. So even if I did click my fingers and make $100 million, let's say, something ridiculous. So I have effectively infinite budget to do marketing. Even then, I'm not sure I would spend it, because if I spend 50 million on marketing, let's say I buy a sponsorship for a sports stadium, branded all about malt, that just gets a whole lot of eyeballs on it. But if the shit's not working, then it's going to fail anyway. My 50 million just went up in smoke. So we need to be sure that it's going to work. This isn't a move fast and break things situation, right? This is how you work in Web 2, because you can. Because when there's problems, you just fix them. You can do that on chain, but that requires you to add a whole bunch of overhead and complexity. That's now a whole other thing that you've got to manage, to have like upgradable proxies and things like that. And as we've seen over time, like they can cause their own issues, right? There's many protocols that have been exploited due to some issue with their proxy. It's not correctly configured or something like that. So again, you have to think about, what are you giving up for taking that edge of adding that proxy? Yeah, you can upgrade now, which is nice, but also it's not as free as Web 2. You can't just push new code in the same way. There's certain rules to what you can and can't upgrade. So you have to think about that. So Web3 is very different. Like the whole crypto landscape, the smart contract landscape, building in that space is very different to building in Web 2. You just can't do the move fast and break things, because move fast and break things in crypto really means move fast and lose a bunch of people's money. And that's not something that I take lightly. Right? Obviously, I have lost people's money in the past, and I've lost my own money, and that's just how things go. But it's not something I take lightly, right? I don't want people to be losing money in avoidable ways, right? If people make dumb decisions, buy a stable coin at $5 and the stabilizer brings it back down to $1 and they get wrecked, I have no qualms with that. I have no issue. But for the individuals that just believed and bought it and then like staked it and lived their life and they end up losing money, like that's not something I take lightly at all. So I'm not going to just pump the coin purely because it makes me money or it makes the degen some higher APR, because what's left when the dust settles on that is everyone who truly believed in me got wrecked, and I am not willing to do that. I would rather not build Malt than have my true believers get wrecked, if avoidable. So that does limit some of the things we can do. But as I've said, to bring it back, like we're building, the protocol's working unbelievably well. I think it's not outside of the realm of possibility that we'll be above 100% collateral in the next week. That doesn't seem crazy to me, given how things have already went. So I think if we're at 100%, we can have more conversations about what the future looks like with a lot more certainty behind us, because we, at least for the time being, have 100%. Of course, it's not guaranteed to stay at that level if the TVL grows. And this is actually another point that's worth discussing, actually, which is Malt is not path to independent, meaning if we go from the 400k TVL that we have right now up to, let's say, 50 million TVL, there's different ways we can get there, right? It can go from 400k and then just get up only, like straight to 50 million, because just there's an article drops in like God's own personal magazine, and everybody wants to buy, right? And it goes straight to 50 million, up only. It's just a barrage of buying, and it just goes straight up. In that case, generally speaking, the protocol won't collateralize that quickly. It will roughly keep up with the growth in TVL, but it won't outpace the growth in TVL because the money's just coming in. And as I say, the money has to go somewhere. So it gets distributed between LP and collateral. But that means if we're getting $1.01 and we're giving 2 cents to LPs, that means only 99 cents is going to collateral. And that's like very heavily skewed towards collateral, right? But in that case, only 99 cents goes in. So we can't be 100% collateralized. We simply cannot be. Because less than 100 cents goes in every time we mint a new malt. So we'll probably settle out at the 99% level when that happens, and that's pretty much where we're at, right? In terms of collateral. So that's just how it works. Just noticed that the prices dropped a little bit, so we're going to get to see the swing trader bring it back again, which is nice to see. Yeah, I've kind of lost the thread there of what I was thinking about, but oh yeah, the kind of disparity of like how quickly the TVL grows, right? So when it's up only 99 cents, like that's a made up number, but it's going to be less than $1 because we're only making, let's say, $1, just over $1. And if some of it's going to LPs, like we're putting less than $1 into the collateral. So at that point, we're just going to be at around the 99% collateral level, and the TVL just grows up to that. And we're at 50 million, and now we've got a ton of collateral, but it's still only 99%. So that's one path that we can get from 400k to 50 million. But the next path is much slower, right? Instead of going straight up, we go from 400k to 500k, and then down to 450, and then up to 550, and then it's just like a constant up and down of TVL and associated market movements. It's a very slow growth. We spend maybe a week at a 400k TVL, and then we move up to 500k and spend a few days there, and all the while the price is fluctuating up and down. It's some people are leaving, some people are entering. It's kind of a revolving door situation, but the general trend is upwards in terms of TVL. In that case, Malt will, in the general case, be much better collateralized, much more collateralized, probably over 100% in a lot of cases, because it profits from directional movements in both directions, right? As the price goes up, it's able to sell, and as the price goes down, it's able to buy back at a discount, which in many cases just increases the collateral, like right out the gate. And we'll probably see that in a few minutes when the swing trader kicks in here, and we're at 99.33%, and the current market price just under 97 cents. So when the swing trader kicks in, then it's going to bring the price back to the 99 cents, and in doing so, that 99.33 should go up, right? Probably not a lot because it's not a big move, but it should go up a little bit. And that's how we're profiting, right? We're constantly in both directions, buying, selling, and the swing trader's profiting in doing that. And that means that when the growth of the TVL is slow, the collateral will generally keep up, and perhaps be over 100%. And then when we're over 100%, we can start thinking about things that we can do with that. Like we can have a community vote, for example, to move some of that additional collateral out of the swing trader and into the runway. So then we can start getting a longer and longer runway. Because that's, I think, another big thing that's missing right now is 26 days of runway as it stands is pretty good, right? That's quite nice, especially given that we basically bootstrapped that runway in 2 hours yesterday, and it's still like in a nice spot. So I think that's something to be proud of. But 26 days of 15% is just not that attractive overall. Especially at the current TVL. But if there was a 50 million TVL and we had a 15% APR that had, let's say, 2 years of runway, that's a whole different ballgame. Because now you can get in for size because the TVL is high, so there's a lot of liquidity in the pool. And 15% for 2 years, that's pretty significant. That means if you've got $1 million, you could park $1 million in Malt, which is 100% collateralized stablecoin, and they can guarantee to pay me 15% for 2 years. That's 300k in yield that I'm going to make in DAI or whatever else assets we have at the time, on a coin that's fully collateralized. Like that, 15% looks real good in those cases. 15% doesn't look good in the case where you've got $1,000 and there's only 20 days of runway. Then it's like, well, cool. Okay, we've got $1,000. Even across a full year, I'm going to make $150, and then pro rata that down. I'm making $10 in 26 days or whatever. It's like, okay, cool. Like I get why people are not overjoyed by that. Of course, I'm not going to stand here and be like, you're all wrong, because they're not. They're absolutely not. Of course, they're correct. But I also urge those people to think about the bigger picture of what we're trying to do. And I think this is missed many times, perhaps because we started off as fundamentally an algo Ponzi, right? V1, I mean, our vision has always been much bigger than that, but V1 was absolutely an algo Ponzi. It was an unsustainable, high APR, fun game to play, and many people had great fun. And I mean, it's still spoken about today as like one of the more fun plays over the last several years. So that's cool. But that does mean that the crowd that's aware of us tends to be not in favor of lower APRs. They want to see degen high APR plays. And that's not what we can give them now. And that's fine. I think they need to respect that we're trying to build something different, and we need to respect that they want to see something different. So with that crowd, we don't have product market fit. But that was always, like, we always knew that. That was never an illusion that that was going to be our long-term crowd, right? We always knew that they're the people who were willing to take the risks. And when you're trying to build a algorithmic stablecoin, really, albeit fully collateralized, if you're trying to build a novel stablecoin protocol, let's put it that way, it's pretty difficult thing to do. So acknowledging that is a big deal too. And so they acknowledge that we're trying to do something difficult, and we acknowledge that they're not the right people for us, and we can iterate and improve. And then over time, we will eventually move away from those like kind of the degens looking for the higher APRs. I mean, I would say they've already moved on at this point. So there's not too much to worry about there. And then over time, the APR will become attractive to the people that it needs to be attractive to, right? So to the institutional clients, to the large net worth individuals, 15% is huge. Like, these people would chop your arm off at 15%. I know many of them personally who lose their mind for 10%, 12%, like 15%, unbelievable for those people. But you have to be trading size, right? You have to be pitching size for that to be meaningful. And that's the real dichotomy that we're fighting right now, is the difference between the kind of base of the pyramid of DeFi, which is just like this huge swathe of degens that have a huge amount of capital total, but individually many of them don't have that much. There are some huge accounts, of course, but overall it's fairly diffuse. And then you have these larger players who have a shitload of money, and it's those people that we're ultimately targeting in the long run, because those people will bite your arm off for 15%. But those people also don't want to take risks on novel protocols. And that's the creative tension that we're fighting right now. And we'll continue to do so, I think, over the next several months, is finding the offering that allows us to transition between those two groups of people. We could pander to the high APR crew and try to figure out ways we can increase the APR. So we could raise money and just put that into the runway and give us some time. We could launch a token and just pump the APR artificially. There's many things we can do to appease that crowd. The other crowd of the large net worth institutions and individuals who will be very happy with a 15% APR, those people need liquidity, right? They don't care about 15% if the market's only liquid enough to get 5K in without major slippage. So we need to grow the TVL to a point where those individuals have the liquidity to enter, and then we're Gucci from there. So that's the battle that we're fighting right now. And I think, as I mentioned earlier, the process of getting to that point is going to be very much figuring out the non-stable pools, because that's a source of yield that we can just tap into without needing people to believe in Malt yet. We can bootstrap that later. But with Malt DAI, they need to believe in Malt, because they need to buy the Malt off the Malt DAI and then stake it, expecting that more people will buy to keep the runway sustaining. So in that sense, like, it has some Ponzi components to it, albeit much more sustainable and lower APRs. But the non-stable ARB is where there's a lot of hidden value that we can try and tap into. So that's where we're at now, and I think if we can do that in short order, we'll be able to branch out into growing the TVL to the point that we can now start pitching product offerings to the institutional clients who want to find access to DeFi. They want yield, and they're happy with a low percentage. And then at that point, there's like plenty of things that we can do in terms of many of these institutions don't want to manage the on-chain stuff. They just want to buy a regulated security or debt token or whatever, like some regulated structured product, and that's what they have. So their book is clean. They don't need to deal with all of the regulatory issues, all of the custodial issues, any of that. They just want to buy something that's regulated, and that's, I think, strategically where we need to be heading. Offering things like that, where we can, that's a huge source of liquidity that comes from outside of DeFi, that we can inject in, that acts as the seed liquidity to get the DeFi natives in, and then there is a point that it becomes self-perpetuating. There's an engine of growth that's built into the thing that becomes very flywheely, in that, like, if there's a load of people coming in, the APR is going to go up, then the runway is going to go up, and then higher runway, higher APR, and more collateral is going to suck more people in, because now it's like, well, this coin's 100% collateralized, is paying a 22% APR, paid in DAI or paid in ETH, and they can sustain this APR for months and months and months. That's where we're going to see a flywheel, and people coming in then beget more people coming in because of the way that the capital thralls internally and the way that the APR grows. And then ideally we want a two-sided market as well. We want some people leaving. We don't want it to be up only, for all the reasons I mentioned before. That slower growth means that the collateral can keep up as we're starting to like arb in both directions. So there's a very clear path from here to somewhere in the future where Malt is much bigger and much more established as a stable coin. And in doing so, staying in the protocol, like as an investor, is going to allow you to capture some of that on the way there, the yield, and then any kind of additional incentives that we launch later, that will functionally relate to skin in the game, as I've mentioned. And there's no better form of skin in the game than having money invested. So there's plenty of things coming down the pipeline that we're excited about. But I think the place I want to end it for now, because we have been going on for over an hour now, is to just really round out how well things are going. It's like they may not be going as well as many of us expected in terms of like TVL growth or overall demand. And it's easy to get bogged down in that. And I'll be lying if I say I haven't been bogged down in that to some degree over the last like 24 hours, because I've put so much time into this over such a long period of time that it does feel like my baby in many ways. And I, for better or worse, bring preconceived notions into the fray, and they're going to affect me in whatever way they do that I don't get to control. But what I do get to control is how I then respond to those things, and how I adapt and behave in the face of all of that. And I think we're already thinking about how we need to adapt. We adapted on V1, V2, and we've ended up with a mechanism that is working very well because we adapted to the behaviors of each iteration, and we'll continue to do that. We'll see the things that are not working this time and improve them, and rechange our strategy as we see fit. And I've already spent an hour explaining how and what we're thinking about there. So I think overall, I'm happy. I'm very happy with how things are going. I think the underpeg mechanism is something that we didn't really get a lot to test in V1 and 2, because if we got there, we're basically dead already. So like in V2, we had a couple of auctions, and then before we paused the whole thing. So I think that's a huge win for us that we really need to focus on that, because we've worked for two and a bit years on this protocol, and the biggest issue for us has always been what happens when we depeg. What happens if the price falls below? It's really easy to sustain above $1, right? It goes above $1, we mint more. We have infinite capacity to mint. We literally control the keys to the kingdom to mint as many Malt as we need. So Malt could go to $1 trillion, and we could stabilize it back down to $1 in 10 seconds, right? A single block, so even less than 10 seconds, right? If we wanted to. It's like trivial to stabilize from any degree above peg. The hard part has always been under peg. And it's always been, we'll just like create enough of an APR that it's not going to fall below peg for a while, because people are just going to be sucking into the protocol, and they're not going to want to leave immediately because they're going to want to farm the high APR for a few hours, and then some of them are going to leave, and eventually that thing's going to die. That's how those things go. But now we have a thing where pretty much all of the activity that's happened in the last 24 hours has been under peg. We've fallen under peg many times. If you look at the chart on Deck Screener, you can see that it almost looks like there's a hard capped ceiling at $1. It's goes below and then comes back to $1. Goes below, comes back to $1. Goes below, comes back to $1. So we've spent the entire time since launch basically doing underpeg things, which has always been the most terrifying part of the protocol. Yet here we are still at 99 cents with 99% collateral and a runway and an APR, and everything's just kind of working despite the fact. So this is why I really want to drive home that this thing has improved an unbelievable amount in the last 2 years. Like if you look at the V1 design compared to what we've got today, it is unbelievably different in terms of its ability to just function and do its thing. Does that mean the APR is lower? Of course. Does that mean that like it's perfect? Like definitely not. It's definitely got loads of room to improve, but it's working in a way that it hasn't ever worked previously. And that's a huge win for us. We've got to take that and move with it and continue to improve it and continue to go. And while over the last 2 years, there's been many teams that have come and went, and teams that have built successfully in that time, teams that have built unsuccessfully in that time, and then there's a lot of churn. But the only way that you can guarantee failure is to stop building, and we haven't stopped building yet. And the trajectory is unbelievably good. Like I wouldn't want to bet against the trajectory that we're on in terms of the ability to just keep going and have a protocol that just continues to work. And as we go weeks and months and years even of protocol stability, we will naturally start to see people inflowing, because we'll move away from people seeing us as the algo stable that failed a bunch of times to being the team that built that algo stable that failed that one time, but now they kept building, and now they have a thing that really works in the way that they've always wanted it to. And we can't overestimate the power of that. And that narrative will naturally suck people in. And of course, by that stage, we're hopefully coming out the bear market, and we have a bunch of utility already built and a community that respects us and all of these positive things that we can then leverage into the next bull market. And really, because it's really quite a difference when you look at, obviously it's not a controlled example, but the kind of growth we saw in V1 versus now, it's like the market is just not frothy anymore. There's just not that much capital. Like it's not, and this is me kind of saying this, I don't have any evidence to back this up, but this is my intuition. It doesn't seem to me like the market is like however much percent, 95% less confident in us now than they were. I don't think that's true. I mean, maybe it is, but I really don't think that is the case. They're somewhat less confident in us, but not 95+%, as the TVL would suggest, right? And that's just a function of the crypto market as it stands, the global markets as they stand, and there's just not that much liquidity. Everybody's feeling the crunch, and it's just not nice. A bunch of people obviously have lost a bunch of money over the last year, and there's just a whole bunch of stuff that we couldn't have predicted happening. But at the end of the day, the protocol is working better than it ever has, ever. And it will continue to get better. And that's all I can say. I invite people to discuss more with us in the Discord and Telegram, on Twitter, and really push us where you think we could improve and where you think the protocol is lacking, and what we can do to improve it, or if you've got any ideas. Like we really want to open it up over time to having like a more open contribution model, so that we can kind of really further the idea that while the idea was mine, the project is not. The protocol is not. The protocol is just, it just is. It exists, and I want anybody to feel like they can contribute if they have something that they feel they can contribute. And I know there's many, many smart people out there who have a lot of ideas and a lot of insights and expertise that we don't have. They can bring a lot to the table. And I would love to get to the point where we could sustainably pay those people. But even before we get to that point, I think we will open up like smaller bounties and things like that to just start cultivating some workflows around open contribution for anybody who wants to participate. And yeah, that's it. We're 24 hours in and things are going great. So it's not going to be too long until we're at a record for Malt. I think 9 a.m. tomorrow will represent a record for Malt in terms of its lifespan, because every other version has always died the following morning. So if we launched on the Wednesday, it dies on the Friday. We launched on the Saturday on V2 and it died on the Monday. So if we make it past Friday morning, so tomorrow morning, we're in uncharted territory and we're up only from there. So everything's a victory after that point. And everything up to this point has been a victory. It's been a great success. So I look forward to seeing more out of the protocol. I look forward to seeing us above 100% collateral. I also enjoy looking forward to growing our runway and seeing what the APR does. So there's plenty things to be excited for. And the number one excitement for me is going to be the day that we roll out the ETH pool. That's always been the holy grail for me, because I personally want that, right? I want to be able to stake my ETH and earn ETH yield based on ARB that's happening, plus whatever LP fees I already get. And yeah, that's it. Thanks for listening. And if anybody's got any questions, I'll let you up to talk, but otherwise we'll end it here. There'll be a recording out soon. Twitter records them, but I also record them separately, and then I'll upload to YouTube, and I will also add the full transcript into MaltGPT to increase the knowledge the MaltGPT has. And yeah, as I say, if you've got any questions, you reach out to me, and let's just build some more. Cool. Thanks, guys. I'll end it here.